Hey, good morning, everyone. Marty Mazzora here. It is the 13th of November, 2025, Thursday. Although it's Thursday, looks like this will be your end of week market message. And I think it's a good day to do the message because equities or stocks, which seems to be what everybody likes to watch during the day, are taking quite the hit in the U.S. this morning. So I'll talk about that. And probably mostly just that. I will touch on gold and the dollar and yields as well, but we don't need to take a lot of time on this one. I would just be regurgitating the messaging that I've given you the last 2 or 3 weeks. So jumping right into it, on the screen in front of you is our table of Fed funds futures pricing. So what you want to look at right here for the December meeting, and this really speaks to what's going on in the market today, I'm certain. It shows now that the odds of a rate cut are just 47% priced in the futures for December. Now that is a marked decline versus where it was even, say, just yesterday. And let me change the date so you'll see that. So yesterday it was nearly 60%. And if you go back to, say, the first of the month, it was nearly 70%. So, folks, the comment I made the other day is that if the Fed really does not want to cut interest rates in December, they're going to have to start signaling that soon to the market, because the Fed would not get in the way of a 70% or 60 or 70% rate cut priced into futures. Now, look, I did a month ago that you can see here that for December it was a 95% probability. So right now, that is problematic for the equity market, I assure you. 2 or 3 Fed governors this week, and I think as recently as this morning, have added fuel to that fire, which I'm sure explains the drop today. It's not that the data necessarily suggests that odds should have plummeted below 50% because we're not getting a lot of data. In fact, the data that we have been able to grab via private sector outlets has suggested that the employment scene has continued to weaken. That would actually improve odds of a Fed rate cut. But what we're hearing from the Fed governors is that, listen, we don't have the data. Without the data, we really can't make a good educated decision. The jobs report via big delay, although there was the government shutdown. So, of course, that's going to be questioned as to whether, it's something that we should be giving much credence to. But what the Fed has said and what Powell has said is that you should not be remotely 100% expecting a December rate cut. We're not there yet, and we need to see more data before we actually get that. So the thing to watch for us, of course, in the short run is going to be the data that does come out over the next few weeks. And right now, the market was so counting on a rate cut that, rate cut, all things equal, would generally be bullish for the markets. And we can get into the weeds in terms of what it would really mean, perhaps longer term. But on a short term, kind of end of the year, looking for that Santa Claus rally, a Fed rate cut helps that narrative. No Fed rate cut really is a headwind for sure. So to take a look here at just the chart. So this is the odds of a rate cut falling. I know it's going up, but essentially when we're talking rate cut, it's a negative number. You can see earlier this morning, there was like a 55% chance of a Fed rate cut, and that just continued to deteriorate to where it's like 47% right now. The yellow line is the S&P 500, so you can see the negative correlation. It doesn't take rocket science to figure out that this really is what's bothering traders so far today. And then here's our 1-year daily chart. Remember, we broke down through this. I showed you this the other day. Got saved at the 50-day moving average. Here we are breaking down again with momentum. Would not surprise me to see the market once again bounce off of that 6,700 mark. Again, seasonality is very, very favorable, and you're going to be looking for lots of positive job owning of the market coming out of Washington over the next few weeks. So we shall see. And you get more of this sentiment. I've been illustrating or expressing our view of all this maniac spending on CapEx in the AI space and our doubts about the ability of these hyperscalers to effectively monetize that spend to the degree that justifies it. Wall Street is beginning to talk about that a lot. So that's hitting tech stocks unusually hard. In fact, since I'm talking about it, the NASDAQ 100 is down 2.25% as we speak. The S&P 500 is down 1 2/3% as I speak, and the Dow is down over 600 points. So clients were definitely feeling it today. Our core portfolio is down 0.83% as I speak. So we are capturing about half of the move in the market, in the stock market. Now, earlier today, we were doing considerably better than that, largely because precious metals are holding up really nicely. But now gold is rolled over and it's down almost 1%. But we've had a really good run of late. Some of it has to do with some adjustments that we made, anticipating the potential for a year-end rally. Of course, those adjustments are giving a lot of that back as I speak today. But again, true to kind of what our objective is, being in a position, being very, very diversified to buffer the hits to what remains a historically expensive U.S. stock market. Where we're actually seeing gains this morning is in one of our individual biotech positions, in one of our lithium miners positions, in AT&T, in a European energy company position, in U.S. healthcare, in energy, in U.S. consumer staples. Healthcare and consumer staples are pretty significant positions for us. And energy is something we've added to of late. And then our position in the yen is actually up by 1/3%. And local currency, emerging market bonds, which we have an ETF position in, is up. And then another one of our biotech stocks is flat. So even as bad and across the board as today's sell-off is, we have 4, 5, 6, 7, 8, 9, 10 of our positions are actually in the green. But, it's modest. There's some pretty sizable losers. Uranium miners are down 4.5% today. Applied Materials is down 4% today as well. So anyway, it's not a mixed bag. It's decidedly lower for sure, so far, at least today. So we'll look to see if there's any dip buying to come. Believe me, there is massive dip buying sentiment going to be still in this market. But if the data and the rhetoric from the Fed continue to push things lower, who knows? Like I said the other day, there's no guarantee that we're going to get that big year-end rally, but the history of that seasonality says that it's still a very distinct possibility. I think that the major challenges are probably going to more come to the fore as we get into 2026. Okay, so the NASDAQ 100 index, same thing, that all-important short-term 20-day moving average, the yellow line that we track. You can see we broke through that, but quickly recaptured it as we did the trend line here. But big down move today, pushing right against that 50-day moving average, just like the S&P. And in both cases, we still have our negative divergences, which makes us cautious going into next year. The dollar is interesting that this is a big risk-off day, and the dollar of late has not been as obvious the risk-off currency. It's actually been the yen. And if you want to go back to our analyses of the last couple of years, we have stated that, and it's been tested during kind of panicky periods in the market. We have said that the yen is going to be the defensive go-to currency, and that's happening today as well. The dollar is actually down 0.32%, while the yen is up about that amount. So interesting dynamics. And what flies in the face of the dollar today is it's not moving with yields like it normally has been of late, meaning the 10-year yield is actually up today. Our long-term treasury bond ETF, which tracks the price, is down 0.5% today. So this move in the 10-year perhaps jibes more with the Fed's concerns and why the Fed may not be eager to cut interest rates in December. And then lastly, gold. As I told you, gold was holding up pretty nicely. In fact, we were up, I think, 1% or so earlier in the day. And right now we're down 1%. So you can see how gold has kind of fallen off a cliff right here. And I can't really see any obvious catalyst. It wouldn't surprise me if that did not coincide to some extent, perhaps, with some more definitive commentary from one or two of the Fed governors that said, we're not going to be cutting rates. So this is gold's sometimes correlation with yields. Gold's a funny thing. People just kind of take it for granted that, that it's always going to go opposite the dollar. Well, it will on a longer term trend basis, but on a shorter term basis, the correlations change often. And it's all about sentiment. Now, one thing about gold, of course, is that it has had a whale of a run, as I pointed out. And it is still, certainly on a monthly basis, very overbought right here. So here you've had, an all-time high sharp sell-off, which we anticipated and we hedged against, as you know. And then you see it coming right back. My bear flag pattern was an utter failure right here. And probably more just technically driven or, let's say, profit-taking in the precious metal space as we speak here today. So certainly today's move is nothing to panic over. And just to update you, pretty much what I said earlier, for those of you who look at this stuff too much, S&P's down about 1 2/3%. NASDAQ is down over 2%. Dow's down 630 points. Core portfolio is down 86 basis points. So about roughly half of what's going on in the stock market today. So all things considered, I'll certainly take that for now, and I'll leave you with that and hope you have a great rest of the week and a wonderful weekend. And I, of course, will be back soon with more. Take care. Bye-bye.